We're going to talk about just a couple of other things in here. One of them, as we just mentioned in some anti-abuse rules, is a curious development that, well, if we look at our SSTB businesses, we know that if you have a business that provides property or services to a specified service trade and business, and the proposed regulations actually had a little definition in there saying, oh, or 80% or more to this related one, and both businesses have a common ownership. They also expanded that in final regs, by the way, to say the attribution rules of common ownership are going to go on here. Well, the way that this worked in the past, I know this gets a little weird, so I'm going to try to break it into an example. Let's say you had a doctor who owned their practice and they also owned the building, and they rent out half of the building to the practice and half to, some other different businesses that aren't his. The proposed regs said, well, okay, 50% of that rental income is specified service trade and business, and 50% is not. They basically had this proposed regulation that talked about whether more than 5% of it was SSTB activity or not. And the bottom line is they started looking at that and saying, wait, we're almost giving permission for people to kind of crack this apart and figure out ways to not, they didn't want to have any sort of a way around that specified service trade and business rule. So what has happened in the final regs? They've pretty much said, yeah, that's not a good idea, and they got rid of that particular component. So again, a difference between the proposed and final, definitely in this arena. So what was it that was eliminated? The proposed regulation 5 that talked about that over 5% rule. They said, okay, your non-specified service trade and business portion, the non-SSTB portion, well, it doesn't matter anymore. It's still going to be SSTB unless you physically break them into two businesses now. We're not going to worry about what percentage is what and what you're doing if you are more than 5%. And why that 5% matters. There is, if you remember the de minimis rule, that if you're under 5% activity for SSTB, it's all going to be considered non-SSTB. So these are all the ones that are over that. And they said, if you're over your SSTB, that's it. Unless you actually break it into two separate businesses here. And the reason, that, again, is because they thought, this is going to lead to some abuse. We really shouldn't have that in there. They pretty much nixed that whole section. So what is breaking into two businesses? Separate set of books and records, and then they corrected that in February to separable set of books and records. Definitely curious, but separable set of books and records, a separate bank account, and probably should make sure you have some different shared expenses, because if you're sharing all of the same wages or overhead between these two businesses, it's going to be really hard to really count one as a SSTB and one not because of that sharing of resources. It's kind of an all or nothing, and that's the bottom line with the final regs. It seemed to be a little hazy, or possibly like they're almost giving us a permission rule in the proposed regs. But in the final regs, it's all or nothing. Either they are specified service trade or business, or they're not. It is not kind of part of it is and part of it isn't. It's all or nothing. We do have the one thing to look at is if it's very small portion that is SSTB activity, if it's under that 5% rule, remember, then it's a not category. So they can have just a tiny, tiny portion, but anything more, then it's going to be SSTB. Why is it important? Well, limitations. They also say you cannot aggregate SSTBs, so you cannot mix them in with other non-SSTB businesses. So that further reduces the ability to abuse the rules, is the reason why you can't aggregate them as well. However, your non-SSTBs can be aggregated. So as long as it's not a specified service trade or business, it can be aggregated. And that helps those non-SSTBs share and maximize the benefit of maybe shared wages or property, or figure out how that can best maximize and benefit them. So since I mentioned aggregation, we're going to get into our last little set of rules talking about aggregation rules. So if you want to make an elective or choosing to make this aggregation, well, first, each business that you're wanting to combine together must rise to the level of being a trade or business. You can't aggregate a true business activity with one that isn't, is the idea there. They can have many businesses, And that Section 199A, when you perform the calculations, it applies separately to each business. If you choose to aggregate, what that does is it treats the ones that you're aggregating together, it treats them all as one business for purposes of the Section 199A. Why would you do that? Well, think if you were able to combine QBI, W-2 wages, and the UBIA, it could potentially maximize the 199A. This is especially going to be useful for the cases for the folks that are over the income threshold limit, where that W-2 wage and UBIA portion becomes really, really important. Was what if you had one business that had all the income and the shared related business had all of the W-2 wages and UBIA, then you'd kind of be out in those cases. So you definitely would want to look at potential aggregation. It is permitted, but it's not required. This is an optional election. The proposed regulations said you can only do that on the individual return at the owner level. The final reg said, you know what, you can go ahead and do that at either the owner or the entity level. So if you have a RPA that aggregates that entity level, guess what? That owner is bound by that aggregation. They can't say, hey guys, I don't want to, combine these companies together. It's not the owner making the determination at that moment. It is the entity that's aggregating. However, after that's done, an owner can still add another, RPAE business into their own aggregation as long as they meet the requirements. So they could take that first one that's been aggregated at the entity level and then mix in their own if it meets the requirements. So they can still do more aggregation, but if it's done at the entity level, they can't undo it at the owner level. It's not really an all or nothing type of election, so it doesn't mean if you do this if you have many businesses that you aggregate, then all of them are mixed together. It doesn't quite work in that fashion, but the one thing that I can say, you have to remain consistent. So when you choose to aggregate those businesses together, you have to do annual reporting on them. You have to make sure and do that, because what happens if you fail to disclose any year? Well, the IRS may disaggregate your companies at that moment. They did give us a little bit of a break for 2018 because they said, yeah, boy, there's so much that's complex, and we just came out with these final regs, and here's what we'll do for you. If you fail to do so in 2018 for this year only, you can go ahead and do that aggregation on a later year, meaning 2019. Or for 2018 only, again, this is for that year only, you can elect to aggregate by amending a return. So they're giving us a little flexibility, a little relief for 2018 that we didn't really have before. You have to attach an annual statement. You have to describe each business. You have to say the name and EIN of the entities, and then any information and changes on operations. So what about kind of changes in operations? Like every single thing that could have happened within a year. So if you think of all that, maybe if there's a business that's closed down or stopped operation, or a new one that's opened up, you get the feeling that there's quite a bit that could happen in that business. Okay, you got to provide that information, or any other information required in forms or instructions or published guidance. So what can happen there is they could change that. So here's where we have to read those pesky little instructions and guidance that comes out with the forms, because that's going to tell us if there's anything that changes with this aggregation, the elective aggregation rule. What are the requirements? 50% of or more of the interest has to be owned for a majority of the tax year, and a 2 out of 3 test has to be met. I'm going to give you what that is, of course. We'll discuss that here in a moment. Each business is a business, meaning for Section 162 purposes, and none of those businesses are SSTB. Remember, we talked about earlier that is prohibited to aggregate an SSTB business. They have to have the same tax years. So if we look at a little bit more into those, just a couple of these, slice them out, 50% or more of the interest owned. Well, the same person or group of persons, either directly or indirectly, owns 50% or more of each business to be aggregated. This definitely can provide some flexibility. The final reg said the same people don't have to own an interest in each entity being considered for aggregation. Now, this can certainly allow minority owners to have a little bit of benefit here, because maybe on their own returns, if they were doing it as an individual, they wouldn't be able to aggregate, where just because of the nature of some other common interest of ownership, that they could aggregate it. So the same exact people don't have to own an interest in each entity being considered. We just have to look at those related rules. So the final regs, section 267 and 707 apply. And how we get to the 50%, those related party rules in those final regs certainly help. Because then we're going to be looking at, as long as somebody meets the 50% test, family attribution is allowed. So it can be considered in the interest either directly or indirectly for spouse, parents, children, grandchildren. I mean, these are all the folks that we can use in these family attribution rules. So it's pretty broad as far as how we're able to consider the aggregation if we wish to do that. Some other requirements, though, that family ownership may sound great, but we have to meet 2 out of the 3 of this test. They have to provide products, services, or property that usually goes together. They have to share facilities or significant elements like personnel or accounting, legal, manufacturing, all these various elements. So think of your shared overhead or resources. And they have to be operated in coordination with or rely on some other business in that group. So think of like supply chain interdependence or vertical or horizontal integration, all these different ways that businesses have to rely on each other. So you have 2 of them of the 3 that you have to meet, or you can't aggregate them. So some ideas in this area, if you think of maybe a food truck and a restaurant, maybe they can be aggregated because they're related. They may use same elements and everything. Or a gas station, a convenience store, those would be some elements as well. Now for your shared facilities, shared elements don't have to be performed by employees, but the catch here is if you only have a common manager, that's not enough. They've got to have some sort of other shared resources or overhead in some fashion.